Hey guys, Freaky Finance here. 2 weeks ago we looked at Suncor. Still haven't bought into it as an update, but it's starting to look more attractive. It was selling off a little bit. Anyway, today we're going to look at another energy play that's a little bit different. It's Capital Power. CPX is the ticker on the TSX. And as a disclaimer, I don't currently have a position in this company. Capital Power is a large energy producer. It has main business in Alberta. And over the past, I want to say half a decade, it's kind of expanded both geographically as well as through renewable energy paths. And this diversification and ability to shift is proving to be critical to the long-term investment thesis for this company. I'll get more into it right now with the map. It kind of shows all the assets. It's a North America play. It used to be heavy in Alberta. It still is. Specifically this site right here, Genesee. There's 3 units here. It's a large part of its portfolio for megawatts. And I guess I should explain more about what power does. Basically, it takes input, say like gas, Nat Gas, and it converts it to power. Or coal converts it to power. Or sunlight converts it to power. Wind converts it to power. Alright, so that's the whole general idea behind the business. Genesee is their kind of, I'd say, flagship area where in the past it has been. It's starting to diversify away from it. In the past it was coal. As of this year, I think they're able to switch now to Nat Gas, or at least in the very short term future, they'll be able to switch to Nat Gas 100% capacity. It actually has the option between 2020 and 2023, or sorry, 2030, to actually either use coal to produce its energy or Nat Gas to produce its energy. The thing about it is that after 2030, Alberta says no more coal. That's why they're doing it. But in between now, for the next decade, they have the ability to use both inputs. So if Nat Gas keeps increasing, coal might start looking more attractive to use as their input cost to make the energy required, right? So it's kind of an interesting asset to have. Another big asset that they acquired last year is Goreway in Ontario. I'm just bringing that up because it shows their diversified footprint, so they have more energy generation in Ontario than they have in the past. All these little green emblems are just wind. Wind is kind of, they're always going to be smaller for a given area for energy production, so none of them are huge on their own. Some of them are over 200 megawatts. Not material currently, but that's the path that it's going. Like every time I look at this map over the years, there's one more little green windmill popping up, right? So it's expanding more into wind as well. Arlington Valley in Arizona is another larger Nat Gas facility, and you can see so far the theme. A lot of their bigger stations are still Nat Gas or converting to Nat Gas from coal. And this is the latest one, Decatur. So this, I just say latest one because the news release, they got a new contract for another 10 years with the provider in Tennessee. So basically, when you make the energy, you have to sell it to somebody, and usually it's utility or the government. And utility can sometimes a crown corporation, the government anyway. But anyway, I digress. So you can see that's their portfolio of assets. These are the 4 main ones. So just to get an idea of the shift that it's currently on and what it's done so far, as you can see, just 6 years ago, coal was 45% of revenue by the fuel type input. Nat Gas was only 10. As of last year, Nat Gas expanded to 38%. Coal was obviously the reciprocal of that, so down 22. So you can see the shift. And that's why I spent some time in that Genesee plant, because that's really where the shift is happening. And renewables has also ticked up over time. And eventually we might even see more renewables and less Nat Gas. And this is just another way to show how they've changed over the last 6 years. You can see gas renewables are now 71% of its business. Before it was 33% because it's coal heavy. So it shifted from a coal focus to Nat Gas focus with a renewable kicker. It's also more diversified than it has been in the past, so that's also a strength. Obviously, you have one area, you have one regulator. So a lot of different markets is a lot better. For the sites, just to show what I mean by energy generation, this is just the 3 months ended, and you can see what the biggest sites are. So Genesee has 3 sites. Alberta is different than the other areas that it's in. Some of their, well, actually quite a few of their power isn't contracted out. So normally you can have like a PPA, which is just a power purchase agreement that says, hey, we're going to produce this amount, you got to buy it. And they'll agree because you don't want to burn out trait or anything like that that could be avoided, or blackout rather. Basically, it just locks in a degree of certainty that someone is always going to be there to buy what you produce, or at least you know what you have to produce to in order to honor your agreement. You can see Alberta contracted facilities right here. There's two of those are the Genesee sites. So Genesee is quite big if you take all 3 units in aggregate for their entire portfolio. I mean, right now it's 9, 6, and 6, so 21 at the 54 total. So it's huge for its portfolio still. And these contracts are actually ending at the end of this year, so it's 4 months away. So that kind of sucks. It's one of the cons I'll talk about later. Ontario, British Columbia, the main one there is the Goreway acquisition, so that's the newest one. So I brought it up. And there's quite a few wind and power in Ontario as well. And then in the US contracted, I talked about the Arlington and Decatur. Those are the 2 biggest ones. I do have the Bloom Wind in Kansas, which is also fairly big. And you can see that over time they're expanding into wind. That's kind of where the capex is going. And then this is another look to see what kind of contracts they have, because the contracts is kind of the certainty of cash flow. That's how I kind of treat it in my mind. So these PPA agreements, who are they with, and how long do they last, right? Like I said, these Alberta ones are the most material ones, and they're ending at the end of this year. So that's the con, but there is quite a lot of certainty here in these other assets, specifically Ontario and the US. This US one for Decatur is outdated now because they just got another 10 years on this agreement to 2030. And these things will always change over time. But like I said, the contract certainty helps me map out in my mind the cash flows, which is important in this kind of environment. And again, this just shows the PPAs for the different facilities. So Decatur was down here, but now it's refreshed 2030, and that's kind of what will happen. They'll rehash the agreement. This is how much power I can make. This is how much power you want. And then kind of go from there, right? And just certainty to get what you produce to market, really. Or even if it doesn't go to market, it goes to the person who can supply it if it needs to. Say if there's a surge in energy demand, the government already has the energy there, right? So that's kind of a pro is the PPA, and obviously a con is if they don't have it anymore. So how do the financials look? So when I mapped it out, capital power revenue year over year did expand quite a bit. This is pre-COVID, obviously, so these are annual numbers. Revenue growth, the main reason here wasn't organic in so much as that they acquired Goreway, which was that Ontario asset that I highlighted at the beginning. They also had margin improvement. When I look into why, as you can see now, Nat Gas is the largest input. It used to be coal. Now it's Nat Gas. And they also have more renewables than they have in the past, and that trend continues to go forth. So lower COGS that way. I mean, when Nat Gas becomes cheaper, then their input cost goes down as long as their output revenue stays the same, right? And that's not always the case. I mean, the energy cost will also probably go down if Nat Gas goes down. But generally it has this kind of like little hedge, if you will. So that's why while revenue expanded, COGS actually went down. And that's a weird thing to see. Also, COGS treatment for renewables is a little bit different. Obviously, you have a lot of capex involved in building the wind turbine, but I mean, the active COGS once the wind turbine's up and running is very small, right? You're gonna have a high capex, some PPE, and they're just gonna appreciate over the life of the asset. It kind of reports differently on the P&L, but you can see the GMD did shoot up quite a bit year over year. Most importantly is the scale. So when their revenue shoots up, do they have to hire a lot of people to do it? No. And that's probably the key for this to work in the long run. Depreciation did shoot up, like I said. They have more assets now than they had in the past through acquisitions. And they also build their own windmills and stuff like that, right? Wind turbines. They did have an impairment charge for the Keephills 3. Other admin did increase slightly. Overall, operating income looks worse, but that's mainly because of the impairment. If I add back the impairment, you're up almost double. Financial expenses trickling up, so one thing that did go down year over year is the balance sheet strength. So they took on some debt when they took on the Goreway acquisition, and they also have quite a bit of capex. So when I go down to here, you can see adjusted EBITDA is $1 billion, cash flow from operations $720 million for a year. But their purchase of PPE and the business, the Goreway acquisition, the aggregate is more than $1 billion. So it took out all of the CFO, right? So, and they also paid their dividend, which is good for shareholders, but on here, obviously, they had to take on debt in order to pay both the capex and the dividends, right? And as well as the business acquisitions. So it wasn't organic growth in 2019 is what I'm trying to say, and it was financed partially by debt. So therefore, the balance sheet looks worse than what it did in the past. And you can see that here with bank indebtedness going up from $22.6 billion to $3.4 billion, right? Offsetting that, obviously, is the assets went up because they have more assets. So their PPE went up about 700 million as well. That's the story going into COVID. They did expand their gigawatts. GM margin is strong when Nat Gas is low. And technically, even though the share price went up between December 31st, 2018 and December 31st, 2019, it actually didn't get more expensive based on EBITDA. So it actually shows that their acquisitions to date have been prudent. Quarterly, so this includes the COVID numbers now for Q2 2020. I just wanted to see what the COVID effect would have. You guys know in Q2 all the commodity markets kind of got hit. It's reversed now, but you got everything falling at the same time. I remember lumber futures are at like 200 and something. Now they're at 800 and something. It's insane right now for lumber. But anyway, all the commodities kind of shot back. But at the time, obviously, their revenue from energy COGS, however, also went down, and that's function of Nat Gas again because it dove down hard. Now it's up quite a bit, but at the time it was down. And their GMD actually stayed fairly steady, and that's kind of what you want to see. This isn't a true utility play; it's still an energy generation play, but it has this kind of hedge if, say, their energy, what they can get at the end, but if they get cheaper at the beginning, it kind of nets itself out. So what I mean by that is that obviously the end power cost that you pay, that they get from the government or from the utility, whatever is the user of the electricity, and we're the end user, but it has to go somewhere once they generate it, right? So that's the revenue part of it, and the COGS part is the input, and Nat Gas is a big part of that still. And coal is as well still. And now they still have the functionality where, say, if Nat Gas shoots up and coal stays lower, they can just swap in coal for that one plant. That's a material plant for them, the Genesee plant. Okay, so SGA did go down a very small amount, but it's important to note when revenue is declining that the management can do something about it. It's not just a function of commodity price input and outputs. So they're actually taking some action. It looks like the company actually improved from operating income, but really it's just the Forex delta of $20,000. So I wouldn't look too much into that. Basically, all this does Q1 to Q2 just shows that the business is still functional in a COVID environment. I mean, your electricity demand doesn't really go down or up in COVID. I mean, that's probably the last thing to cut is my power. Share price did increase quite a bit. It's actually now it's just below 30, or I think it's 29.30 when it closed yesterday. But their debt did increase slightly. They did purchase another wind facility in Texas for 84 million. So that's why this PPE shot up. I wanted to see why their capex shoot up like that during a contraction period, right? So I wanted to make sure it made sense. So they acquired something, hopefully cheaper than what it's worth during lows of COVID. But we'll see, and that's just more of an example of them going more and more into wind. Their electricity generated actually went down in the quarter with COVID. However, their margins offset it. Lower Nat Gas prices for their input costs. And then market cap. So this little valuation is still cheaper than it was, say, on the 2018 and 2019 levels based on the last quarter, even if the last quarter wasn't that great. But it's not as cheap as it was, and that's kind of highlighted on the price. If I just go to the chart here, move me over here, you can just see that it slowly started trudging up from the 23.46 all the way up to 29. And one of the reasons you want to look at this type of company, one, it's renewable, so that's a good thing, or it's shifting to renewable, I guess is the better way to word it. And so far, it looks like it has the ability to do so, whereas a lot of companies have struggled with this rotation. So far, Capital Power, it looks like it's executing well, like it's actively, it truly is switching from a coal company to now with Nat Gas dominant, and soon coal will be trickled out and will literally be Nat Gas and renewables. And hopefully more and more renewables over time, because that's the trend that I think the world wants to go. Anyway, I digress again, but you can see the share price action over time, fairly positive. Management's been aggressively growing, and COVID is it hasn't dented the company like I think the share price is priced in, but I'm going to dig through that in the pros and cons in a second. Alright, so let's go through some pros and cons. The first pro, Capital Power has been aggressively growing in the past few years through either acquisition or improving or upgrading its existing facilities, say the Genesee site that I talked about quite a bit. Annual revenue has gone from 1.43 billion in 2018 to 1.96 billion in 2019. Yeah. So, and EBITDA also increased 40% year over year. So it's on the up and up. It's done it not through organic growth per se, but it's diversifying across. Now it's in Ontario, and it has more Nat Gas than it has before, and it keeps expanding into wind. and it has some solar projects on the way. So there's quite a bit going on. The second pro is the dividend looks safe. So this is always dicey because it's COVID, and I mean, that's the first thing you would cut right now if I was this company. But currently, it looks like the dividend is sustainable for the operations. That being said, they could always cut it anyway just to have more of a margin of safety, but I mean, they have a 7% yield, so it's a high yielding dividend in this kind of environment when you have treasury yielding nothing and this almost quasi, it's not quite a utility, but just quasi energy generation company is yielding 7%, right? So it looks really good from a dividend point of view. According to guidance, the sustained capital for 2020 is only 100 million. I find that kind of funny. Adjusted funds from operations is 550 million to compare that, so they can cover the dividend and the sustained capital, because the dividend was about 260 million, and the sustained capital is 100 million, so that's 360 million. And then you have their adjusted funds from operations, which looks like it's going to be about 500 million, right? So they cover it with their funds from operations. That's what I'm trying to get a point here across. Interesting though is that the sustaining capex is only 100 million when depreciation is at almost 500 million a year. And I'm just bringing that up because it shows just how capital intensive this type of industry is, and that's why the margins are as high as they are. The third pro is the long-term contracts and cash flow. So the PPA part, the company states 50% of cash flow is from outside Alberta and 100% is contracted outside of Alberta. Therefore, currently 80% of the entire business is contracted. That's going to change at the end of 2020, but it's still a strength at this time. It's always nice to know what you produce is going to sell, and I always like the contracts that they lock in. So the more contracts, the better in my point of view. They can line up more. It's great, like they just did with the Arlington plant in Tennessee. All right, and the fourth pro, the company is increasingly more diversified across different regulatory markets. So Goreway made Ontario a larger footprint. The U.S. assets are spread out well, and the larger ones appear to be in Alabama, Arizona, and North Carolina. I talked about the first two. Next pro, revenue growth trend shows capital slowing, phasing out of coal. What I mean by that is that they're just reducing their coal input, and that's what you want to see because that's what they're supposed to be doing. What I mean by that is that the government of Alberta has awarded a grant for phasing out coal for this company. Basically, government of Alberta doesn't want any source of energy to be sourced by coal after 2030, and it's actually given a grant for them to do that. It's not a small grant. They're getting about 51 million a year until 2030, so it's a decent amount. It shows up on their balance sheet as a receivable, so I thought that was a unique thing to bring up. But yeah, anyway, they get some of that coming in for switching over to coal, and now they have the capacity for the next 10 years for that Genesee site to alternate between the two if it's more accretive for valuation, right? If coal just stays cheap and Nat Gas shoots up, they're just going to use coal as the input cost. And that's kind of a unique thing for these next 10 years, and I kind of like that agility, or flexibility rather. The last pro, the company's growth plans and rotation out of coal appear to be working well year over year. The gross margin continues to actually tick up, and that's kind of what you expect with more and more renewables anyway, but it shows that they're doing this transition prudently, and they're using its existing cash flow to do it. It's not taking on too much debt. It has taken on some debt in the last year, but it still doesn't look too bad from a balance sheet perspective. So the first con, growth has been partially fueled by debt. So additionally, the Goreway acquisition increased debt by a material amount. I talked about that quite a bit. The total indebtedness went from 2.6 billion to 3.4 billion, and shares were also issued for this back in 2019. The second con, free cash flow statement looks unfavorable at first glance, as the CFO is much lower than what the PPE growth and acquisitions have been. It's hard to factor out what true sustaining capital requirements for internal growth upgrades would be. So right now they're guiding 100 million, but how accurate is that? And that's hard to map in my mind. If the CFO, cash flow from operations is lower, it's obviously harder to just put more money into your business if your cash flow from operations is lower. So that's why the dividends is kind of, I mean, if it does get bad, that's what they're going to cut, right? I mean, that's just prudent from an executive level. The third con is not sure who exactly the counterparties are. Sometimes they list who the PPA holder is. Usually it's, like I said, the regulatory government. But sometimes it could be like BC Hydro. And it's hard to map that in my mind. But, I mean, most of them are going to be able to honor the contract. Most of them are governments or quasi-governments. The fourth con, so change management. So the CEO was planning to retire in 2020, but has since signed out for 3 years, or sorry, signed up for 3 years. As of July 30th, the conference call, the CFO is being demoted, and the treasurer from inside is being promoted to CFO. So that's kind of weak in this kind of environment. But we'll see what happens. Whenever I see change like that on the top, I'm like, okay, what's going on inside? I thought the CEO was going to leave. All of a sudden, he signed back on because things are bad, or he wants to deal with it, doesn't want to put it on somebody else. I don't know, right? But whenever there's a change like that, I'm always like, okay, is there a shift in vision? Because right now they need to keep going into renewables. The fifth con, the drip reinstatement, actually this is a con for me. It does save cash, obviously. Anytime you have a drip, you just get or more shares instead of the actual dividend cash payment. But it also leads to shareholder dilution. So if I don't have the drip, say if I buy it and I'm not enrolled in the drip, then I slowly get diluted, even though I still get the nice dividend. And because the yield's so high, because the share price is down quite a bit, your dilution effect is a little bit higher. I mean, so is your cash flow if you buy it now, but but it's still a concern. Some concern may be warranted for that drip. And the last con is the company can have large swings in reported EPS due to the impairment charges, as it sells assets and acquires new ones. When it's doing this kind of rotation, there could be some more, say that Keep Hills 401 million impairment charge that could happen again, right? You don't know. And you don't know how the market's going to react to that, right? I've seen some impairment charges get hit, and the market all of a sudden thinks this company is going nowhere, and then you get a big opportunity to buy, right? So if I buy now, my front running an impairment charge I don't see coming, I don't know. But it's just something to keep in mind. So to conclude, my thinking is that the underlying options appear resilient to the pandemic. Interestingly, revenue dropped in Q2 2020 versus Q1 2020 from the 533 million to the 435 million, but the GMD barely decreased. It went down like 13 million. So with operating income actually increasing quarter over quarter, it's kind of strange to see that in a COVID environment. I mean, you wouldn't expect technically energy to go down because our energy demand doesn't go down just because we're not working, especially if you have stimulus to still pay for your bills. It looks like the continued rotation out of coal may have actually improved both the GM and operating margin percentage, and also overcoming the higher interest expense from the debt. It looks like the company has been able to position itself well against the energy price decline with the contracts based on the Q2 results. On the negative, there is the Genesee 1 and 2 units with the PPAs expiring December 2020. For energy's sake, to understand how important that purchase agreement is, it is 13% of its total capacity to produce. So I think it's 860 megawatts a year of their 640 or 6,400 megawatt portfolio. It's not small. That's something to keep in your mind going into the end of this year. How will it look when those two contracts are no longer on the PPA, or those two sites? They did lock in that 825 megawatt Alabama and Decatur energy site, and the market reacted favorably to that. It actually shot up 6% that day. That pretty much took it from that 27 to the 29. I think it also printed 30 briefly. It went up quite a bit on that news, and that's the power of the PPA, right? It just gives you that much certainty into your cash flow. The long-term contracts do look interesting, and I imagine the utility structure should help in a potential stagflationary environment. So what I mean by that is that the high dividend will likely be sought out in a low risk-free rate world. Therefore, in light of this potential stagflation setup, with the stocks trading down, or the stock trading down year to date, even though the EBITDA is likely only going to be down 5 to 10%, it's probably a buy. I see only 3 wind turbine sites that expressly state fixed price contracts, and they only generate 478 megawatts a year. So my understanding is that the other sites should be able to pass inflation to the buyer if it occurs over time. So what I mean by that is if inflation ticks up, they'll just pass it on to the end user. They'll pass it on to the government. We'll see how it works, because I don't know exactly how the PPAs are structured for passing on inflation. Some of them are indexed. I don't think the debt should be an issue at this point. The company also has a $1 billion credit facility, with only $100 million drawn on it. Any unforeseen liquidity issues in the interim should be okay, should be mitigated. I think the stable cash flows is the largest reason to buy into this company. And as per their Q2 call, they said the average contract life is greater than 10 years still. So that gives you some certainty into that there's always going to be a buyer for what they produce, which is nice in a COVID environment, right? And that also shores up the dividend. They do keep acquiring and taking on debt to fuel its EBITDA growth, so it is something to watch in the future if the balance sheet deteriorates further. But right now, based on all current information, I think it's probably worth the risk. Obviously, my main worry being that upcoming December 2020 Genesee 1 and 2 PPA expiry and how that translates into the P&L, right? If they get a worse price because the Alberta market's crap, how does that look? Or does it even impact it at all? They do hedge quite a bit. They have some natural hedges. That's the risk. So right now, I don't have a bid in for it yet. I was looking at it. It looks like it wants to get under 28 again. So I might do it just because of the dividend yield, but it won't be a full position if I do. A part of me wants to just say, well, 7%, let's do it. But at the same time, I don't know what this is going to look like in a year. I just want to see what the Genesee feels out in the P&L. And then with Nat Gas prices shooting back up like they have, how's Q3 going to look? There's a lot of uncertainty there and a lot of volatility. I think the dividend's still safe, so that's why I'm entertaining the idea. I'm looking at it under 28, and if I do buy it, it won't be a full position. It'll probably be half of a position. So anyway, I'd like to hear your thoughts on Capital Power, and have a great weekend.